Good afternoon, everyone. Today we will continue to explore the actors in the economical hierarchy, such as institutional investors and banks. We will then look at the areas of the free market where they operate, in particular stock exchange and IPOs, followed by foreign exchange markets. And finally, we will do an easy introduction into derivatives, which are specifically designed financial instruments that help me, you, companies, or anyone to mitigate risk or speculate. So we begin with institutional investors, and they are legal entities that trade in the financial markets. They would include hedge and large mutual funds, banks, credit union, pension funds, or insurance companies, or even governments. They can produce both positive and negative externalities for the stakeholders of the stock market. They produce great economic value due to their size. You can easily achieve more with a lot of resources. Also, their presence as shareholders tends to improve corporate governance. Moreover, institutional investors can benefit from a larger variety of financial instruments only available to them due to their size. Institutional investors always are a legal entity, and it is important to understand that an institutional investor is a managing firm, not a fund itself. Institutional investors will manage assets based on the interests and goals of its clients. In order to function correctly and in the best interests of shareholders, institutional investors have a comprehensive set of bylaws and dividend payout policies, which govern their fair relationships with stakeholders and help to avoid casualties in the market in the form of economic loss for the investors. Moving on, we will briefly discuss the three types of banks today, and to begin with the commercial banks. This type concentrates on working with incorporated customers, even though some commercial banks also offer services to individuals, wealthy individuals. Both large corporations and small firms can use their services when they need to open a checking or savings account, borrow money, get access to the credit funds, and transfer funds to the companies in foreign markets. With the investment banks like Morgan Stanley, Goldman Sachs, JP Morgan perhaps here, they have a lot of responsibilities. On one hand, they manage the trading of stocks, bonds, and other securities between companies and investors. They do advisory for individuals and corporations in areas of financial guidance, mergers and acquisitions, and they also manage investment portfolios, as well as raising money for businesses or even, again, federal governments. They do that for them. Talk about lobbying. And finally, retail banks. They offer members of the general public financial products and services such as bank accounts. This is your regular bank you find in the street. Deutsche, well, I don't know about Sparkasse if it's that regular, but say Commerz, all of those retail banks. They open bank accounts for people, give them loans, credit cards, insurance. In some cases, they can set up a checking account and make loans for small-scale businesses as well. In retail banks, they can be traditional, brick and mortar, when you walk in and do things, and they offer online services with that as well. But we are transforming as the world, and financial industry is no exception. And other banks, well, new banks, they make their tools and accounts available only online and through mobile apps such as Monzo in the UK or N26. Here, the Austrian startup operates Germany, Netherlands. And this is it about the banks. And so now we come on the part which is perhaps could be of the most interest for you and us. It is the stock market, the place where a lot of fun happens. And well, this is why. It's the place which serves two very important purposes. Firstly, it provides capital to companies by offering stock shares instead of borrowing the cash for operational activities and plans. This way, the company will avoid taking on debt and as a result paying the interest on that debt. And the second purpose of the stock market is to give investors the opportunity to participate in the income of publicly traded multinational organizations. Investors can profit from stock buying in one of two ways. Firstly, they buy it and they wait for the stock price to increase relative to when they bought it, or they buy shorted or they shorted, expecting the stock price to go down, or there are stocks that simply pay out dividends. Well, stocks are traded in Wall Street, Canary Wharf, City, Paris, Hong Kong, Singapore, and many other places. There are also a lot of trading names for them, as you see on the slide. S&P 500, FTSE 100, Dow Jones, and well, DAX in Germany here, perhaps. However, some stocks do not attain the strict requirements of the Federal Commission, which oversight the fair conduct of business in a particular country or region. Therefore, they are traded through an OTC, over the counter, through a broker or market maker who is dealing with a particular stock, which does not meet the price requirements of the large stock exchange. As an example, they're a little bit shady. Well, we all saw Jordan Belfort doing it to them in the Wolf of Wall Street movie. Not to that extreme, but this is basically how reliable that they are if you look at them. There's, as I have mentioned previously, a very important thing that happens in the stock market, which is the IPO. Investment banks handle the initial public offering of stock. It happens when a firm first decides to become a publicly traded company by offering stock shares. Shares offered in IPOs are most commonly purchased by large institutional investors, such as pension funds or mutual fund companies. They happen through an agreement, not initially available to the larger public. However, after that, the IPO market is known as primary for that reason, or initial market. But once the stocks have been issued, in the primary market, all of the trading in the stock thereafter occurs through the stock exchanges and what is known the secondary market. The term secondary might be a little bit misleading, but think about it, the sequence. IPO is primary, then when it's available for the larger public, it's secondary market. And this is where the overwhelming majority of the stock trading occurs day to day, where you can go Robinhood, Vanguard, and get it for yourself, for example. The next large market which influenced the way that economy is moving and the businesses operate is the foreign exchange market. It is the least visible, yet one of the largest markets, with daily trading volume of $5 trillion on average a day. Many countries have their own currencies. When companies trade internationally, they need to convert their profits earned in foreign currency into their domestic currency to finance their production, for example. Institutional investors will need currencies to invest around the world. Banks make loans and receive payments in many different currencies where they operate or just to the general public. However, the foreign exchange market, it is intangible. It exists as an OTC over the counter as well, because participants trade directly with each other. And this market is self-regulated as well. Entities will, people, businesses, governments, they will elect those they trade with, and no single entity or government has control over it. We also have reserve currency of the United States of dollars. It is the term applied to whichever currency is dominant in the market at this point of time. And when the value, for example, when the value of the dollar rises against sterling or British pound, it means that the dollar has appreciated against the pound, and the pound has depreciated relative to the dollar. Here you can see a currency price chart. It's a United States dollar index. It basically shows you what is said on the slide, how well dollar performs against the basket of currencies of America's closest trading partners. And there you see 92.32. Today, this number is around 94.5. It's the real-time measurement of how dollar is performing against other major currencies in the world. A great tool for you to use to see how it moves and maybe make decisions for yourself. And now, the final and the most kind of complex part of the workshop today is derivatives. The practical value of derivatives lays in the ability to mitigate risk. This is basically hedging. In more detail, it would be hedging, which is practically defined as your attempt to protect yourself from the downside outcome in a particular deal, or speculation, which I hope every single one of us knows. And in simple terms, it is trading on the expectation that the price of the underlying asset will go up or down. Therefore, it will determine the sort of position you're willing to take, whether you take short or long position. If you don't know what short or long position is, it will be explained. Don't worry. In the course of our workshops in Investment Academy, we're going to talk about options, futures, and forwards. And today, for, simplicity purposes, and they're all going to be discussed in more detail, in 2 weeks when we talk about risk management, but we will leave options aside for today because they are more complex and might be more complicated to understand the period of time that we have right now. But we will talk about futures and forwards as the instruments to mitigate risk. And with an example of a farmer, we will explain to you how they could be used in the real life. So please assimilate yourself with the task, well, with the little case that is written on the slide right now, while I'll continue talking. Let's assume I'm a farmer. I know I will have apples because I'm a farmer. I produce apples, I will harvest them in October, and it means that I will be in a long position in apples in October. Nevertheless, I also expect the price of the apples to reduce because it seems like a very good year, very good weather, and there will be plenty of supply. According to the basic economic laws, when there is a lot of competition from the producer side, the prices go down, usually. And we take this assumption. Depending on how and with who I trade, I can enter either a future contract, which is, and now it's very important to remember, which is a standardized contract which is traded on the exchange. There is an intermediary involved, which is an exchange. It's basically a protection from the either side of this contract, from the default of the other side. And this standardized contract, which is traded on the exchange, has a predetermined expiration date, in our case, let's say 1st of October, and predetermined quantity. For example, 1 ton of apples to be delivered on the 1st of October. This is the future. Or as a farmer who has apples on the 1st of October, I can draw up a forward contract with the buyer, which is practically the same thing and serve the same purposes and outcomes as future, but it can be tailored and it is not regulated by the exchange. So there is higher risk with the forward. But because of its flexibility, it's also a thing and the market for it is huge. So I hope by now you have read a little question here with the graph. So let me read it again. Let's assume we're a farmer. We expect to harvest 100 tons of apples in October at time T+1. The spot price in March S0, S stands for spot, for today is 100. And October futures trade at 105. Again, I expect it to be a very good year and the prices to drop. And I want to protect myself from those prices drop. And I can enter a future or perhaps a forward contract, which gives the right and obligation to deliver 100 tons of apples in October for a price of 105 per ton. However, the weather was bad and the supply was limited. And the price in the market has risen to 108. This means that I already have the right. This means that I sell my apples for the price of 105 per ton, and I lose 3 per ton against the market price on that particular day. So my net loss will be 3 per ton on this day. And now is the question that I want to ask you guys. I deliberately left it out. What happens if the price of apples in the time as T+1 goes to 102? Does anyone want to answer? Yes, we have an answer from Bernard. It's correct. Oh, it's not correct. The farmer hasn't lost the money. He protected himself with the future. So he has the right and obligation to sell at the price of 105. If the price is going to 102, it means that the farmer has made money. He has made 3 per ton of apples on that particular day. So if the price for the apples goes up and you're in a future position, you're losing because you're missing the opportunity to sell your apples for 108. But when the price is down to 102, it means that your hedge was right, you're successful, and you're going to gain 3 above the market price on that day. This is the same for forward, and I hope you have remembered the main distinction between them. With the options, they're not, which we're going to touch again in 2 weeks. They're not an obligation, they are a right to buy. So there are a few more variables involved in them, and they're more complex, but they're very, very interesting. At this point, I would love to end. I would love to go into discussion, but before we do that, does anyone or do any of you have any questions